Hey everyone, and welcome back to Senior Security Updates. I'm your host, Zane, and if you are retired, approaching retirement, or if someone in your household depends on Social Security income, then I need you to stop what you're doing right now and give this your full attention, because what we're covering today is genuinely important. Something significant is unfolding within the Social Security system, and it's happening right now, in early March 2026. The reality is that a large number of Americans are completely unaware of these developments. And when people aren't informed about changes like these, it can directly affect how much money they receive, create unnecessary stress, and leave them dealing with problems they weren't prepared for. So here at Senior Security Updates, our goal is always the same: break everything down in plain, straightforward language. No confusing government terminology, no overwhelming financial jargon. Just clear, honest information so that by the time this video is over, you'll know exactly what's happening and what steps you can take. Let's get into it. The big picture. A lot has changed in a short time. Let's start by zooming out and looking at the bigger picture. The year 2026 has already brought more movement within the Social Security program than most people have had a chance to follow, and we're barely into the third month. When we talk about changes, we're not referring to minor adjustments. We're talking about shifts that affect how much money lands in your account every month. Changes to how the government manages appointments and customer service. Changes to how much you can earn from work while collecting benefits. Changes related to how your benefits may be taxed. And significant changes for a large group of public workers, teachers, police officers, firefighters, and other government employees who have been waiting years to receive the full benefits they earned. Each one of these updates can have a real, tangible impact on your day-to-day financial life. So we're going to go through them one by one, step by step. And by the end, you'll be in a much stronger position to manage your benefits and plan ahead. Let's start with the change that tends to get the most attention: the cost of living adjustment. The 2026 Cost of Living Adjustment, COLA. Every year, the Social Security Administration reviews price trends across the country, things like groceries, housing costs, prescription medications, and fuel, and then adjusts monthly benefit amounts to help recipients keep pace with rising costs. This annual adjustment is called the Cost of Living Adjustment, or COLA. For 2026, that adjustment comes in at 2.8%. Now let's translate that into actual dollars, because percentages can be hard to visualize. In 2025, the average retired worker in the United States was receiving approximately $2,015 per month in Social Security benefits. After the 2.8% COLA, that average monthly payment has moved up to around $2,070 per month. That's an increase of roughly $56 each month, which adds up to approximately $672 over the course of a full year. For married couples where both spouses receive Social Security, the combined monthly increase is even more noticeable, roughly $88 per month more, bringing their average combined benefit to around $3,280 monthly. That sounds like a meaningful improvement, and in many respects it is. But there's an important factor that needs to be addressed honestly, because here at Senior Security Updates, we believe you deserve the full picture, not just the highlights. The Medicare premium. Offset, what it means for your take-home amount. If you are 65 or older and enrolled in Medicare, your Medicare Part B premium is automatically deducted from your Social Security payment each month. That has been the standard practice for years. The issue in 2026 is that Medicare Part B premiums also increased by approximately $17.90 per month, rising from around $185 per month up to roughly $210.90 per month. So here's the math that many people don't factor in. Your Social Security check went up by about $56, but your Medicare deduction went up by about $18. That means the real net increase that most Medicare-enrolled recipients will actually see deposited is closer to $38 per month, not the full $56. That's still additional money, and on a fixed income, every dollar has value. But understanding the actual net increase helps you avoid confusion when your bank statement doesn't quite match the number you heard about. If you haven't taken a look at your updated benefit amount since the start of the year, Now is a good time to do that. You can log into your My Social Security account directly at ssa.gov to review your current monthly net amount and make sure everything lines up with what you expect. Major customer service changes. Starting March 7, 2026. This next update is causing real concern among many older Americans, and it's something that a lot of people are just now starting to become aware of. Starting on March 7, 2026, the Social Security Administration is making a significant change to how it handles appointments and customer service. For many years, if you needed assistance from Social Security, whether it was a question about your benefits, a change to report, a new enrollment, or an issue with your account, you could call or visit your local Social Security office. That office served the people in its surrounding community, the staff was familiar with local needs, and appointments could often be scheduled directly through that local office. That model is now changing. Beginning March 7th, the Social Security Administration is shifting to a centralized, nationwide scheduling system. In simple terms, your local office will no longer be managing its own appointment calendar. All of that will now be routed through a single national system. The stated purpose behind this change is to improve staffing efficiency and standardize service across the country. However, many advocates for older Americans have raised concerns that the practical experience for retirees may include longer wait times, more difficulty scheduling appointments, and added frustration when trying to resolve something time-sensitive. Here's what that could look like in practice. Right now, if you need an appointment at your local Social Security office, you can call, wait on hold for a bit, and typically get connected to someone who can schedule you. After March 7th, you'll be directed through a national phone system, which may mean longer hold times and representatives who are less familiar with your local area or specific situation. For anyone dealing with something urgent, a benefit issue, an identity concern, or starting to receive benefits for the first time, this kind of delay can create real problems. So here's the key takeaway from Zane and the Senior Security Updates team. If there is anything Social Security related that you've been putting off, please try to address it before March 7th. File online through ssa.gov wherever possible. If you need an in-person appointment, schedule it now, before the transition happens. Don't wait, and then find yourself navigating a more complicated system at the worst possible time. Getting ahead of this change could save you significant time and stress. The earnings test. What working retirees need to know. Let's move on to something that catches a lot of people off guard. The earnings test. This applies specifically to people who have started collecting Social Security benefits, but have not yet reached their full retirement age, and who are still earning income from a job. Here's how it works. If you're receiving Social Security before reaching your full retirement age and you're still working, there is a limit to how much you can earn before the Social Security Administration begins temporarily reducing your monthly benefit. Your full retirement age, often referred to as FRA, depends on your birth year. For anyone born in 1960 or later, the full retirement age is 67. For those born in 1959, it's slightly lower, 66 years and 10 months. For 2026, the earnings threshold has been updated. If you are under your full retirement age for the entire year, you can now earn up to $24,480 before any reduction applies. That figure went up from $23,400 in 2025. If your earnings go above that limit, Social Security may temporarily hold back $1 for every $2 you earn beyond the threshold. For example, if your total work earnings for the year come to $40,000, the difference above the limit is about $15,520. Half of that, approximately $7,660, could be temporarily withheld from your benefits over the course of the year. The word temporarily is critical here, and it's where a lot of misunderstanding occurs. The money that's withheld is not permanently lost. Once you reach your full retirement age, the Social Security Administration recalculates your benefit and restores credit for the months that were reduced. Your monthly payment actually increases to reflect those withheld months. So it's more accurately described as a deferral than a penalty. But you still need to know about it, so a smaller than expected check doesn't come as a surprise. For individuals who will reach their full retirement age sometime during 2026, a different and higher limit applies for the months leading up to that birthday, 65,360. And for that group, the reduction ratio is $1 for every $3 earned above the limit, rather than $1 for every $2. And once you have officially reached your full retirement age, the earnings test no longer applies at all. You can earn any amount from employment without any effect on your Social Security payments. The Social Security Fairness Act, long overdue relief for public workers. Now let's talk about something that represents genuinely good news for a large group of Americans who have been waiting a very long time for this. For decades, two provisions within the Social Security system, known as the Windfall Elimination Provision and the Government Pension Offset, significantly reduced or even eliminated Social Security benefits for millions of workers in certain public sector jobs. This included teachers in many states, as well as police officers, firefighters, and other government employees whose positions did not contribute to Social Security. These individuals spent their careers in public service, often accepting lower salaries than comparable private sector positions. And on top of that, they were subject to these benefit reductions that many felt were fundamentally unjust. Advocates had been working to reform these rules for many years. In early 2025, Congress passed the Social Security Fairness Act, which was signed into law. This legislation removed both the windfall elimination provision and the government pension offset entirely. For affected workers, this translated into meaningful increases in their monthly Social Security payments. Many of these individuals also received retroactive lump sum payments to compensate for the amounts they had been shortchanged in prior months. However, there is an important tax consideration that many people did not anticipate. Those retroactive lump sum payments, which could amount to several $1,000s for some individuals, may be considered taxable income. That could result in a smaller tax refund or even a tax liability when filing a 2025 federal return. There is currently a legislative proposal in Congress, the No Tax on Restored Benefits Act, that would exempt those retroactive payments from federal taxation. However, as of the time this video was produced, that bill has not yet been enacted into law. If you are a teacher, firefighter, police officer, or any other public employee who received one of these lump sum payments, please consult with a qualified tax professional before filing your return. This is not something you want to discover after the fact. The positive news going forward is that your regular monthly benefit is now simply higher, and you can benefit fully from the Social Security Fairness Act without facing the same tax complexity in future years. The long-term financial health of Social Security. Every person who relies on Social Security, or expects to rely on it someday, should have at least a basic understanding of where the program stands financially. The Social Security Trust Fund, which serves as a reserve to help cover benefit payments, is facing growing financial pressure. Analysts have been raising concerns for years that without legislative changes, the trust fund could reach depletion sometime in the early 2030s, with some projections pointing to 2032 or 2033. If that were to occur, it would not mean the program disappears. But under current law, benefits could be subject to an automatic reduction of roughly 20 to 23% across the board. That kind of reduction would have serious consequences for tens of millions of Americans who depend on this income for essential living expenses. Several factors are contributing to this pressure. The large generation of Americans born between 1946 and 1964, often referred to as baby boomers, are retiring in significant numbers, which means more people are drawing from the system. At the same time, birth rates have declined, so there are proportionally fewer younger workers contributing payroll taxes relative to the number of retirees collecting benefits. Additionally, recent program expansions, including the Social Security Fairness Act, add costs without new offsetting revenue sources. This is not a reason to panic. Congress has addressed Social Security's financial challenges in the past, and there is strong political motivation to prevent benefit cuts. But it is a reason to stay informed, stay engaged, and encourage your elected representatives to address the funding gap sooner rather than later. The longer action is delayed, the more difficult the eventual solutions become. At Senior Security Updates, we believe you have every right to understand the full picture when it comes to the program that forms the foundation of retirement income for so many Americans. A new tax deduction for Americans 65 and older. Here's something that could actually put more money back in your pocket, and many people don't know it exists yet. As part of tax and budget legislation passed by Congress in the summer of 2025, a new tax deduction is available for older Americans beginning in the 2026 tax year. Here's how it works. If you were 65 or older by the end of 2025, you may be eligible to deduct up to $6,000 from your taxable income. This is a separate deduction that comes on top of the standard deduction that all taxpayers can claim. There are income limits attached. For single filers, the full $6,000 deduction is available if your adjusted gross income is under $75,000. For married couples filing jointly, the combined income threshold is $150,000. For those whose income exceeds these limits, the deduction gradually phases out, meaning it decreases as income rises rather than disappearing all at once. For many people who fall within the eligible income range, this deduction has the potential to reduce, or in some cases entirely eliminate, the federal income tax on their Social Security benefits. That represents real, meaningful savings. Make sure your tax preparer is aware of this deduction, because it's new and not yet widely known. A lot of eligible people may miss out simply because no one told them about it. This is exactly the kind of thing the Senior Security Updates channel exists to bring to your attention. The Social Security wage cap has increased. Here's another update worth knowing, particularly for higher-earning workers. Social Security payroll taxes are only applied to wages up to a certain income ceiling each year. In 2025, that ceiling was $176,100. For 2026, it has been raised to $184,500. For most workers, this change doesn't affect day-to-day finances directly, since it applies to income above that threshold. But it does have relevance to the overall revenue flowing into the Social Security system, and for workers earning above the new cap, a slightly larger portion of their income will be subject to Social Security taxes in 2026 compared to last year. Earning Social Security credits in 2026. For anyone who is still building towards Social Security eligibility, meaning you haven't yet accumulated the 40 credits required to qualify for retirement benefits, there's a small but important adjustment to note. In 2026, you need to earn $1,190 in wages or self-employment income to receive one Social Security credit. That figure increased from $1,810 in 2025. You can earn a maximum of 4 credits per year, and you reach that maximum once your earnings hit $7,560. To qualify for Social Security retirement benefits at all, you generally need a minimum of 10 years of earning 4 credits per year. This is especially relevant for younger workers, gig economy workers, or anyone working part-time who wants to make sure they're building toward eligibility. When should you start claiming Social Security? For anyone who hasn't yet started collecting benefits, one of the most consequential financial decisions you'll face is choosing when to begin. This choice can influence your total lifetime income by tens of thousands of dollars, so it's worth taking seriously. The earliest age at which you can begin receiving Social Security retirement benefits is 62. However, if you start at 62, your monthly payment is permanently reduced compared to what you would receive by waiting until your full retirement age. Depending on your birth year, that reduction can be as much as 25 to 30%. To put that in concrete terms, if your full benefit at age 67 would be $2,000 per month, claiming at 62 might bring you something closer to $400 to $1,500 monthly, and that reduced amount stays with you for the rest of your life. On the other hand, waiting beyond your full retirement age allows your benefit to grow further. For each year you delay past your FRA, up to age 70, your benefit increases by approximately 8% per year through what are called delayed retirement credits. So if your full benefit at 67 is $2,000, waiting until 70 could bring your monthly payment closer to $2,480. For someone who lives well into their 80s or beyond, the accumulated difference between claiming early and waiting can be quite substantial. If you're in good health and have the financial flexibility to wait, delaying your claim is often one of the most effective strategies for maximizing long-term Social Security income. That said, everyone's situation is different. Health, financial needs, marital status, and other factors all play a role. This is a decision worth discussing with a Social Security specialist or qualified financial planner who can look at your specific circumstances. What you should do right now. Let's pull everything together and talk about practical steps you can take today based on everything we've covered. Step 1. Log into your My Social Security account at ssa.gov. If you don't have an account yet, create one. It's free and takes just a few minutes. Once you're in, you can verify your benefit amount, review your COLA increase, check that your earnings history is accurate, and see exactly what you're scheduled to receive going forward. Step 2. Take care of any pending Social Security business before March 7th. That's the date the new centralized scheduling system takes effect, and navigating appointments may become more time-consuming after that transition. If you have paperwork to submit, submit it now. If you need to schedule an appointment, do it today. Don't let this one slip by. Step 3. If you are a public employee who received a retroactive lump sum payment under the Social Security Fairness Act, speak with a tax professional before you file your taxes. An unexpected tax bill is the last thing you want to discover after the deadline has passed. Step 4. If you are 65 or older and your income falls within the thresholds we discussed, make sure your tax preparer is aware of the new $6,000 deduction. This is money you're entitled to, and it's easy to miss if your preparer isn't specifically looking for it. Step 5. If you haven't started collecting Social Security yet and are weighing your options on timing, take time to think through the decision carefully. Consider consulting with a Social Security advisor or financial planner who can model the numbers based on your specific age, health, income needs, and goals, and help you determine the approach that makes the most sense for your life. Closing thoughts from Zane at Senior Security Updates. Here's where we land. Social Security is not a perfect system, and it's going through a notable period of change right now. Some of those changes work in your favor. Others introduce new complexities that require your attention. But one thing remains constant. This program is the financial cornerstone of retirement for tens of millions of Americans, and staying informed about what's happening with it is one of the most meaningful things you can do to protect your financial security. The updates we covered today, the 2.8% COLA and the Medicare offset, the March 7th customer service transition, the updated earnings limits, the Social Security Fairness Act and its tax implications, the new senior tax deduction, the Social Security credit threshold, and the program's long-term funding outlook. Every one of these affects real people managing real expenses. You deserve to understand all of it. Knowledge truly is power, especially when it comes to your retirement. So if you found this helpful, please share this video with someone in your life who is receiving Social Security or getting close to retirement age, because they need to hear this too. And if you have questions, drop them in the comments section below. The Senior Security Updates team reads every comment and will do our best to help. This video is intended for informational and educational purposes only. It does not constitute financial, tax, or legal advice. Please consult a qualified professional for guidance specific to your personal situation. Thanks for watching. Stay informed, stay protected, and we'll see you in the next one, right here on Senior Security Updates.